Great. Well, I think our strategy really depends greatly upon what the adoption of electronic trading technology is in one given domicile. And I think that Australia has historically been slow in adopting to our type of technology. I think the reason is domestic institutions were very focused on the bundled model and paying Wall Street brokers. If you look at the participants on the Aussie exchange and rank them according to market share and volume, there's never been an agency broker in the top 10. It's all, at least the institutional volume, it's all been street brokers, and it's very concentrated. You see really a classic 80-20 type rule where the top end of the participants really make up the bulk of the market share. So it's always been a difficult place for domestic penetration. Because Australia offered an offshore license that we had before, we were able to service our customer base that traded Australia from a remote membership here in Hong Kong. And so global institutions that were using Instinet to trade in Australia were more than happy to utilize the desk in Hong Kong, and all of our trading tools were available. All of our algos and other products were available electronically. We started to notice the winds of change coming in Australia a couple of years ago, and there's been a lot of talk about best execution and regulatory impetus for changing trading there. And I think it's very clear that both the implicit and explicit costs of trading in Australia seem to be higher than they were in the rest of the world. The explicit cost was higher because there wasn't a tradition of using execution-only brokers, so the commission rates paid were predominantly for full service, and the implicit rates were higher because of the knowledge leakage of everybody only trading with the big powerful firms on the street and trying to source blocks from people that also had prop trading desks. So it looked to us as though the environment was ripe for reform, and it clearly looked the same to the regulator and the government as well, because what the big trigger was when they announced that ASIC would take over the regulation of market participants from the ASX. ASX was self-regulating, so if anybody wanted to start an alternative market, for example, they had to apply through the ASX, and that was not a recipe for any great amount of change. It's generally been a time where people need to use our technology more. So it makes the relevance of having an execution management system to manage your workflow, having analytics to manage your analysis of whether you're getting best execution, and having the algos and smart routers to not only trade in the market, but to trade in alternative venues is becoming more important to investors in Australia. So that's kind of explains the timing of our getting bigger in Australia. And in terms of our adding resources on the ground, it's a combination of trying to focus more on the Australian clients and also moving some resources that had been in Hong Kong, servicing our global clients and trading Australian equities onto the ground in Australia. The next things to look out for is, now that Chi-X has been approved, when are they going to start trading, and will clearing be opened up to other alternative markets? Because right now, the ASX group, the monopoly, still owns the clearing pipes, and have suggested some terms publicly for other participants that didn't seem very workable. So we need to find out where clearing lands. Then we need to find out where ASIC comes in on best execution, because I think it's one thing to have alternative means to execute, but it's also important to have a best execution mandate from the regulator that says you have to use brokers that are capable of getting you best execution and capable of using the venues that are available